All right. Well, thanks for those of you who joined us on time. Out of respect to your all's time and Keith's time, we're going to go ahead and jump in and get started. And guys, the time of the year is coming when most of our transactions are starting to wrap up, and we're starting to think towards 2023. One of the things that we need to think about in 2022 is how we are going to be going about the tax scenario of all the business that we just completed in 22. Now, some of you are brand new agents and maybe you haven't closed any deals yet. This is still great information for you to put in your notes, so that when next year rolls around this time, you've already got everything systematized, you're tracking everything, so that when you go to your version of Keith or Keith himself, you are prepared emotionally and financially to fulfill your financial commitments to Mr. Sam, Uncle Sam. So I'm gonna introduce Keith real quickly. So Keith was actually introduced to me from Tabitha. Tabitha was my productivity coach when I first started in real estate. And I realized quickly that real estate, being a 1099 gig, is completely different than being a W-2 9 to 5 typical job that you may have had in the past. W-2 is pretty simple, self-explanatory, and most people can kind of figure out how to do that on their own, filing wise. But I knew that I wanted to make sure that I was capitalizing on anything that could be a potential write-off, and I wanted to go to somebody who knew what the heck they were doing. So my wife and I have trusted Keith now for the last 3 or 4 years. He always does a great job, timely in answering any questions, comments, concerns that we have. And your first few years, you're going to have plenty in regards to taxes and real estate. So here to answer some of those questions today is Mr. Keith Brown. Keith, why don't you take a minute and introduce yourself? Tell us a little bit about yourself.
Yeah, sure. Thanks, Josh. Yeah, so I'm a CPA. I've been a CPA since the mid 90s, I guess. And I've been in the preparing taxes and doing accounting work and things like that for now going on a little over 30 years. So I started young. I started right out of a 2-year school, and then got into the business, and then ultimately finished getting a bachelor's and a master's degree in taxation kind of as I was working in the business. So it's been a lifelong journey, and it's been fun. So as much as taxes can be fun, right?
Yeah. And speaking of, I'm sure you have hobbies and like cool stuff that you do. I've never seen you get too up or too down about anything. Tell us a little bit, like what are some things you do for fun, Keith?
Yeah, well, honestly, most of what I do is I've got between my wife and I, we've got 5 kids. that keep us busy. Our youngest is just turned 14, and she's involved in volleyball. So definitely enjoy watching the girls play volleyball. Personally, I play basketball on Tuesdays and Thursday nights. Growing up, basketball was my love, and I spent probably 30 hours a week playing basketball just on my own and pickup games, things like that. So
Wow,
that's
a little
probably the
known
thing I
fact.
do the most.
I'm glad I asked. So I'm pretty tall, and I've seen you in person, Keith. So you must have some pretty good ball skills.
Well, it's funny. I'm 50. I just turned 50 in June. So I'm playing against guys that are half my age and even some younger. So it's challenging. I'm not the way I used to be. I don't move the way I used to. My mind wants to do things that my body just can't do. But one of the things I can do is shoot the ball. So that's usually what I do. I just sit back and take shots. So it's not too bad.
Well, hopefully you're not taking shots while you're doing our taxes.
No.
And that's the alcohol shot. That's a little joke.
Yeah.
But here's so you've been in the industry for like 30 years. What have been some major changes over the course of 30 years in taxes?
Yeah, I mean, in taxes, we always just think about what law changes happen from year to year, and there's always something that changes most every year. Some things touch a lot of people, and some things don't. Probably the biggest thing that I can think of right now is in 2018 when Trump made all of his tax law changes. That had some pretty widespread changes that affected most everybody. So I would point to the 2018 tax law changes, and we're probably headed for another major change to, quite frankly, reverse a lot of the things that he did. I can see that coming soon.
So that's one key, as you're saying that you probably want a CPA who is involved in things that are changing and understanding legislation. And I know Keith definitely does that for you. As you answer this next question, I'm going to go ahead and put your contact information into the chat. Guys on the call, agents, if while Keith is talking and answering some of these questions, we're going to get into more granular stuff here. If you have questions, go ahead and put them in the chat. And then when we're concluded, we'll either get to it then at the end, or if it's imperative to answer now while we're in the topic, please just go ahead and put those things in the chat. But I do want you all to have Keith's information because Keith is outstanding at what he does, and I want to toot his horn and give him or bless him for taking this time. So if you are looking for a CPA, somebody to help you with your taxes or answer questions, I want you to feel comfortable using Keith. But next question is, Keith, here. When helping a realtor do their taxes for the first time, what are some of the things that typically come as a surprise to the agent? Maybe things that we weren't quite prepared for.
Yeah, I think you kind of mentioned at the top, Josh. Most people are used to wages and just earning a W-2 wage, and once you take that step into being self-employed and getting a 1099 now instead of just a W-2 wage with all the withholdings, what you find is the tax laws are designed to help businesses. They're not designed to help those employees who just earn a wage. So what we can do is we can start getting into some specifics here in a minute, but there's a lot that you can deduct. And what I find, especially for folks who are new to the industry and new to business, is they tend to not track their expenses. And so what I find the most is people will lose deductions just because they haven't taken the time to track it. So we'll talk a little bit more about that later as well. But that's probably the biggest thing is to really take the time to learn that. What a couple of things that people aren't aware of is the self-employment taxes. That's a whole layer of taxes that they're not used to. Self-employment taxes are made up of your Social Security and Medicare. And it adds about 15% to your tax bill. So a lot of people are surprised when they get their first return and I tell them how much they owe, and then all of a sudden they start thinking about all these expenses and things that they forgot about because they realize how beneficial it is. So that's probably a big thing, is the self-employment issue. And there are things we can do to plan around that. So not necessarily a discussion for today, but something, if you have any questions on that, hit me up and we can talk it through. Um, the other thing is city taxes as it relates to your guys' industry. We tend to have to pay taxes for where you guys earn your commissions. So being able to track your taxes by city is important. So those are probably the few things that I would say kind of surprise people.
Yeah, as you say that, that was, there's been several times throughout our relationship where you have to ask me for additional information. And that city tax was something that never dawned on me because I never really had to in the W-2 job. But if you guys sell a home in Delaware County or Delaware City, it's going to be taxed differently than if you sell a home in Dublin or Columbus or any other area. So tracking that information is so, so important. And so for those of you in coaching or those of you just running your own business, my hope is that we're running a really clean P&L that allows you visibility to expenses, but also a transaction management like calculator. Where are you selling at? Physically location, where are you selling your homes at? So that when it comes time for Keith to help you, it's a little bit easier for both of you. In an ideal situation, Keith, what information should an agent be bringing to you when it comes time to file taxes?
Well, you just mentioned it, Josh. I mean, I think two things. One, on the revenue or commission side of things, is just being able to provide. And what I see from the folks I deal with, and that probably is the easiest, is like an Excel spreadsheet or something that as you sell a home, put the commission amount and the city, the address, put the address on where you sold that, and just keep a running tab of everything that you sell and the address that you sell it for. That way I can help you determine what city you need to work with, or your CPA can help you determine what city that you need to file and so on. But that'll be the first thing. So keeping track of your revenue or commissions by city. And the second thing is just to have a mechanism to track all of your expenses and to keep a summary of all of that. Whether you use something like Excel, again, where you can just have the transaction and then along the columns put the type of expense it is, whether it's a telephone expense or office supplies or rent or whatever it is, just have the columns, have those on it, and then each row be the transaction, and just keep track of it. So then at the end of the year, we can summarize that and can get the information we need to capture all of your expenses. You can even take that from a more sophisticated program like QuickBooks, and we can talk more about that later. But you could utilize software to help you track all of your expenses. But to me, the best thing for us is just to get a good summary of all of your revenue and expenses.
Yeah, I want to share a screen. And so this is just an example of what I do. You can do your own thing and don't pay attention to the numbers or anything. But the left column here, can you all see my screen? These are the categories that I track. And so when tax time comes, I'm able to send Keith a really easy synopsis and breakdown of what I spent. This is all my income. And then we've got things that we pay for, things like monthly dues, things like if you pay somebody to do showings, etc. Internet, Photoshop for me, if you're doing that for marketing, car, like mileage is a write-off, right, Keith?
That's correct. Yes.
And so we drive as realtors, we drive a lot. And with gas prices the way they are, you should really be tracking that. There are tracking devices out there that you can use. Insurance, all these different marketing opportunities. You sometimes don't realize how many different buckets you're putting your money into until you really sit down and think about it. So if you've never started a P&L, I really want to encourage you to get that started. You got to remember, you are a business. And any good business knows exactly where they're at with their pennies. And we got to be pinching pennies, but we also we realize we're spending money. And so we want those things to be write-off. So if you guys have questions about P&L and like what I'd recommend, I can share with you. And maybe yours is even better than mine. But even meals and hotels if you're traveling, if you're paying for coaching, these things are things that could get you additional deductions. I'll stop sharing now. Also, me and my team, we use a spreadsheet and we just track every single transaction, and every transaction has a city and a zip code on it so that when tax time comes, I know exactly what the locations are.
And be careful with that, Josh. Sometimes you may think you're selling a house that has a Worthington address, but it's really in the city of Columbus. That's the reason why, for me, having the actual address there, we have the state of Ohio has a nice program that we can use to actually see what city each of those addresses are physically in, and that's what we're most concerned about. So be careful. Don't think that just because it has a Columbus address or a Worthington or a Westerville that it's actually in those cities.
Good call. So let's talk about write-offs and deductions. What can I write off? What can't I? I know you're not gonna be able to go through everything, but what are some good ways that you've seen, maybe in and over what I've just shared, to track different write-off options?
Yeah. Well, here's how I like to always start this conversation is everything's deductible. The rules, the IRS rules is, I'm going to tell you the entire rule and what's allowed, as long as it's ordinary and necessary. That's it. That's what the rule says. So anything that fits into that, you can deduct. So what that means is, you can't go and buy a Lamborghini and use that as a write-off, because it's just not ordinary. Most realtors don't drive around in Lamborghinis, I'm guessing. Um, and as long as it's necessary for the business, so that means everything. So what I also encourage, especially the folks that are new to it, is to start thinking about all the resources that you use when you're doing business. A lot of times we're so used to paying for things personally that we end up not deducting it because of that. So things like cell phones, your internet connection at home office deductions, uh, mileage we just talked about, the brokerage fees, the advertising, you guys have a lot of things that go into it. If you bought business cards or signs or whatever, all that stuff is deductible. What about your computer that you use at home, or your desk that you use in your home office? All these things are now deductible, where before they wouldn't have been, because you're just a W-2 wage person that might be working from home sometimes. Now everything you do and use is deductible. So take a few months, think about everything. Every time you're doing business, just force yourself to think about all the resources and tools that you're using and make sure you're deducting them.
While we're on this topic, Cinnamon just asked, can I deduct home office expenses if I also have an office at the brokerage?
As long as you're doing work from home. So the rule is it has to be a designated space. So you can't have a corner of your living room that you have a desk set up, but you also spend your evenings watching TV in that room as well. It has to be a designated space, and it just has to be used for business. So, but what's important about that question is also relating to the mileage issue as well. So the question really is, what is your place of business? In our tax world, we call that, what is your tax home? So do you spend more time doing business from your home office or from the brokerage office? Like, for example, for me, I spend most of my time in my office, not in my home. So the significance to that is two things. It's the mileage from home to my office is not deductible. Okay. Whereas if I worked mainly from home, but just came into the office, once a month or once a week, just for a meeting or whatever, but I spend most of my time working from home, then any mileage from your home to anywhere else would be deductible, or certainly from home to the office would still be deductible. But if you're spending any kind of time at home, even if you do work from the office a fair amount, I would say as long as you can justify that you spend some time doing work from home, you can take the home office deduction.
Good question. In regards to that, so I remember asking Keith this question. We were going to have floors put down in our house. And I believe, and correct me if I'm wrong here, but if you take the square footage and you calculate how much is your office space, even like home improvements can, a portion of that could be used as home office improvements.
Yeah, so there's two different ways to take a home office deduction. And this came out of that 2018 tax law changes, by the way. This is when this first changed. Is now you can, the easy way, they call it the simplified method, is you can just take a square footage of your house, so, or your room, your home office. So let's say you had a room that was a 10 by 10 room, so it's 100 square feet. You can take $5 per square foot as a deduction. So that's the simplified method. You don't get any other benefits like Josh is talking about in terms of repairs and maintenance and anything else. It's the simplified method. It's designed to be simple. So we just take $5 times the square footage of our house, and that becomes our deduction. Not the house, but of the office. The second way of doing it is to take the actual expenses. So if you had repairs, maintenance, you do landscaping outside, you have somebody come in and clean your house a couple times a month, your interest that you pay on your mortgage, your real estate taxes that you pay, you can take a percentage based on the square footage of your office to the square footage of your total house. So usually it's usually it's typically around 7, 8, 9%, something like that. Times all of those deductions. So utilities, insurances, everything that's related to your whole house, you can take that percentage of. And you can do whichever is greater. You can do it, you can change year by year. You can do the simplified method this year because you didn't take the time to allocate all those or track all those costs. And then next year you want to start doing it. So next year you can switch and start doing the other method. But the point is you can do whatever's best each year.
Yeah, what resonates with me from what you just said is the simplified method in your scenario would be $500
Right.
credit, right?
That's right.
Versus
Deduction.
deduction versus if you're like what he was saying, like cleaners every other week or whatever, or landscaping and stuff. I'm sure that most of us, if we really thought hard about it, are sinking more than $500 credit into that. So just again, it all comes down to tracking. And Kevin, and to that point, Kevin has a great question. Do deductions need to be just documented, or is original receipts necessary?
Original receipts where you can, and maybe I'll say it differently. If you get audited, they will likely want to see an original receipt, and maybe even more than just a receipt. In today's world, what I'm seeing, if you think about it, everybody buys everything off of Amazon, right? So what happens in an audit situation, if you get audited and they want to challenge a number, if you just give them an Amazon receipt, how do they know that receipt is for a business purchase or something that you use personally? There's no way of knowing. So not only will you need the receipt, but you might need to document on the receipt the business purpose of it. So that would be the ideal situation. A lot of people will bring their bank statements and show the Amazon purchase there. Well, that's not probably going to be good enough because, like I said, you can buy anything at Amazon. And I've seen that happen before where they'll just disallow anything that, Walmart's, Kroger, all these things that you can get a lot of different things from. They're just going to disallow those unless you have receipts. So the recommendation would be have receipts, and not only have the receipt, but document the business purpose of it.
Great. Lauren, you have your hand raised.
Yeah, this is kind of a silly question, but I don't by any means have to write anything off, correct? And the reason I'm asking is because, also correct me if I'm wrong with this, but when buying a home, they look at your income after taxes and write-offs and all that. So I would want the most amount of income documented so I could get approved for the largest amount. So if that's the case, if I'm trying to show that I make more and not write off a lot, then I don't need to write off a bunch of stuff if I don't want to, right?
Yeah, it's a good question, Lauren. Actually, a lot of people come to me with this kind of a thing. Hey, I need to make $100,000 this year because I'm trying to buy a house, right? So that it's kind of a sticky situation. The short answer is you're right. You don't have to deduct it. Certainly, if you spend money on something that's a business deduction but don't deduct it, nobody's going to know. Nobody's going to challenge you on that. From a tax standpoint, the IRS certainly isn't going to come and say, "Oh, you should have deducted your office expense and you didn't." They're not going to do that. But what I wouldn't do, and certainly in general wouldn't give tax advice to anybody, but what I wouldn't do is recommend that people do that, because if a lender is lending you money based on you making $50,000 a year, but really you only make 30 because you have all these expenses. I don't know enough about it, but I suppose they can come back to you at some point with that being an issue, because maybe you overstated your income. So from a legal standpoint, you may have an issue, but from a tax standpoint, you're right. We'll deduct what you tell us to deduct.
Yeah,
Okay, that makes sense.
I
Thank
don't
you.
think Uncle Sam will be mad for keeping more money than.
That's
than
right. And it is a catch-22 because you will pay a lot more taxes. But I've had it happen where people, would rather pay the taxes and be able to buy a house.
That's a great question, Lauren, and something I really hadn't considered. So I just bought an investment property and we financed it, and turns out, Lauren, that scenario not exactly played out, but there were some additional questions from underwriting about, like, hey, you said you made this much, but the taxes are showing this much. Like, what's the scoop there? And I just said, I got a great CPA. He makes me look like I'm homeless. It's great. Okay, and if you have additional questions about write-offs, just keep them coming in the chat, please. Estimated quarterly payments versus filing all at once. Keith, what are your thoughts and opinions and how to go about it, those things?
Yeah. So anytime you have at least $1,000 due on your federal return, the IRS wants you to pay that over 4 quarterly payments instead of all at once. So it's more of a requirement, not an option. So what we think about there is in the payment dates right now are the middle of April, June, September, and January of each year. They're looking to change that, by the way. They're going to try to make it more of a 15th of the month following the quarter end. But for now, that's what we have. So the answer is we should try to make quarterly estimates if you plan on owing more than $1,000, and not pay that all at once. The difference is you would likely be subject to penalties and interest, and I like to equate it to basically putting things on a high interest credit card. So that's the kind of penalties and interest you'll get, from not paying it on those quarterly dates.
Requires you to be organized. And how can we all, especially new agents, how can we all be organized? It's through our calendar. So setting a quarterly reminder in your calendar, preferably probably a week before the deadline, so that you're getting those things in prior to the finish line.
Yeah, and with you guys not having necessarily a fixed income, you earn as you close on a property, so you could have a good first quarter and a bad second quarter. So, it wouldn't be bad for you to work with your CPA each quarter to determine kind of where you are, and pay that taxes as you go through the year, instead of just, a lot of times what we do, because it's all we have available, is we estimate what you pay based on what your previous year did. But don't be afraid to track things and be in a position, like Josh is saying, to know where your numbers are as you go through the year, so we can help you pay what you actually owe, instead of having you pay a bunch of extra or underpay for that matter, and be subject to penalties and interest.
Yeah, I always remember it as a W-2. I always, like, my goal was to get money back from the government at the end of the year. And I think that's typical for young people, but in reality, your goal is to not owe anything and not get anything back, because you would have given the government the exact amount that they were owed. And so you still have as much money as you would have received back from the government. Anyways, but yeah, in this scenario, we want to be, we want to follow the rules. Sam has a question. I started the year as a W-2. I have not closed any deals yet, but I have had business expenses. am I able to use those write-offs towards my W-2 income for this year?
Good question. The answer is yes. As long as you are considered in business. So even if you haven't sold anything yet or transacted anything yet, as long as you are holding yourself out and you are considered to be in business, then those expenses are deductible. And if you have expenses greater than your revenue, then they can offset your wages with the type of income that you guys have.
Awesome. I'm going to throw, I know I sent you questions over. I'm going to throw another one in here. LLCs. A lot of realtors utilize LLCs. How does that change things when, let's say you're married filing jointly? Like, does that throw a major wrench into that? How's it work?
Well, keep in mind, an LLC is a state law concept. So anytime you guys set up an entity, you're setting it up with state of Ohio. So, you're logging into the Ohio Secretary of State's website and you're going through the process, right? From a tax standpoint, if you are the only owner of that LLC, then you are treated as a sole proprietorship. So what that means is we just file a form, an extra form as part of your personal taxes. With that, we can then think about if we want to be taxed differently than that. That's the default, is you'll be a sole proprietorship. And we have the option of changing that if we want. It doesn't change the LLC. The LLC will always and forever be your entity. That'll never change. All we would possibly do is tell the IRS we want to be taxed differently. And there's some tax advantages to being taxed someone other than a sole proprietorship. But if you're married and filing a joint return, we would still file all of that income under your Social Security number. So if there is profit, you would be subject to self-employment taxes, so Social Security and Medicare, and all of that will go under your name. So even though we're filing a joint return, we'll still track everything under your personal name.
Okay. Thanks for clarifying there. What information would you give us, or what advice would you give us that will make both of our jobs easier come, January, when we get this information over to you? Is there a best way you've seen to track information and submit it to you?
Yeah. Honestly, it's a bit of a cost. And so roughly probably $25 a month, but I would say tracking all of your activity through a program like QuickBooks. QuickBooks has an online version. You can access it from an app on your phone. So when you're just sitting waiting for a showing or whatever, you can actually log in that day and spend 5 or 10 minutes a day and have all of your accounting caught up, and the system does a great job with reports. So if you ever need to give anything to a bank or anything like that, you have it all ready to go. But to me, that's a great tool, using a program like QuickBooks, because then we can easily access it. It's easy to transfer data between us, and it gives us everything we need to know to do your taxes.
As long as you input it all, as long as
Yeah,
you, the
well,
individual,
and that's what the
inputs
5
it.
or 10 minutes a day would do. Some people don't like to deal with this part of it. I get it. That's why I have a job. So I appreciate the fact that a lot of people don't like to do it. But the program's pretty simple to use, and with a couple of clicks of a mouse, you can record all of your accounting and have all of your financials available to you. It's really not that overwhelming. The only time it really gets overwhelming is when people have to do months at a time. So doing a couple of days or even a week at a time, it won't take you long at all. And actually you probably will find that you enjoy it because it helps you keep a good handle on what's going on with your business.
It's great advice. We've got we ran through those questions pretty quickly. I've got a couple things from a real estate realtor's perspective, some things that we might run into, guys. And if you haven't already, you may hear some of these terms thrown around. But things like 1031 exchange. Do you deal with those, Keith? 1031 exchange, basically in a nutshell, is a way to defer your tax burden on real estate. So if you're dealing with investors, which a lot of newer agents, typically we get tied up with investors a lot. They're looking for ways to pinch pennies just like we are through our business. And when they go to sell a property, if they want to, my understanding is defer the tax payment, they can roll that their funds into another property as long as they meet certain rules and restrictions, and therefore postpone that tax burden. Do you deal with those, Keith, or
I
like what
do.
other information
Yeah.
can you share?
Yeah. So that's a good summary, Josh. I'll tell you what, we can spend 3 weeks on these topics and go through all the things that you need to go through and the things that a realtor might encounter, maybe with a client or maybe at some point with themselves. Certainly 1031 exchanges is something that you should always think about. One of the things as you guys start growing in your business and dealing more is, I know in my business, I always say, there's 100,000 people in Columbus that can prepare tax returns. What makes us different? And so you guys can think about the same thing. And what can make you different is just being not giving tax advice, but just being aware of the issues and the things that are out there relating to real estate, that you can at least start working with your clients on. There's the 1031 exchange where you're allowed to defer your gain if you sell a property, as long as you buy another property. And there's lots of rules and restrictions to it. There's people who may want to use their retirement accounts to fund investments in properties, and there's a lot of rules and restrictions to that. I just ran across a client who's in the process of buying a rental property, and one of the big things these days is cost segregation studies. So typically when you buy a property, we can deduct that property, and let's call it a single family home for a minute. We can deduct that single family home over 27 and a half years. So one of the misconceptions that people have about real estate is, hey, I need a write-off. I'm going to go and buy some real estate. I'm going to put a bunch of money and fix it up, and I get to write all that off. Well, it's not true. So what happens is when I tell them, you get to write off, $3,000 of your purchase this year, they're upset because they thought they were going to get a $50,000, $60,000, $70,000 write-off. But what you can do is to help that, you can do a cost segregation study, and that'll help to transition some of those deductions to maybe being able to write off all in 1 year. So this guy got a segregation. Just to give you a quick example, he's purchasing a $400,000 single family home, and he had a cost segregation study done. He's going to be able to deduct $90,000 in the first year. So a couple things to think about on that. And in his case, when you're dealing with real estate, one of the things we have to think about is a lot of times it's passive activity, which means, I've got this single family home, somebody's renting it. I don't do anything but collect rents each month and everything's fine, right? These are the kinds of things that your clients are buying. Well, in those cases, that guy's not going to be able to deduct the $90,000 all in the first year. And he didn't know that until he talked to me. The guy that he spoke to that was helping him with brokerage the deal told him he'd be able to write off the $90,000 as long as he helped manage the property, which he will. And they didn't get into the actual details of it. So the point is, he could be in a situation where he thought he was going to get a huge deduction and not. So there's ways we can structure it. We can offer additional services to the people who are renting it. That'll create a situation that allows us to deduct it. The point is, there's a lot of rules related to purchasing investment property, how you can purchase it, how we're able to maximize the deductions on it, how we can defer the gains on this 1031. There's a lot of things. That's why I said we can spend weeks talking about it. So if you have anything like that, or have any thoughts or ideas, or clients that might have these things going on, reach out to me, and I can help you guys talk it through with them and make sure we're giving them the best advice they can maximize their deductions or defer any gains.
You mentioned cost segregation study. Who does that? Is that something you all do, or?
It's not something I do. You want to get somebody that's what they do. That they and here's essentially how it would work. When you think about, and in this case, the one that just happened, I'll speak to that one because it's most recent in my mind. So it's $400,000 house, single family home that was fully furnished. Okay. So what happens is you go in and if he spends 400,000, that's written off over 27 and a half years. But the furnishings inside of it, we can write off all in the first year. So what we do is we go in, we take the cost and we segregate out all the furniture and say, okay, if the furniture all adds up to 20 grand, now we have $20,000 that we can deduct all in the first year. We don't have to spread that over 27 and a half. Cabinets, light fixtures, all these kinds of things that flooring, there's certain types of flooring that we can write off all in the first year. Well, how much, if you bought a house for 400 grand, how much is the flooring in the house? Maybe it's another 10,000. The roof we can deduct over all in 1 year. HVAC we can deduct all in 1 year. These are all new recent law changes, but now we have this ability that if all we need to do is have somebody come in and help us segregate out the cost of all of these different items, and that's what will give us that huge write-off. There's companies out there that do it. You just want to search out somebody that specializes in doing the cost segregation study. I know it costs a few $1,000s, but probably more, probably up to $5 grand to have the study done. So it's not something you want to do if it's not going to benefit you. So you definitely want to weigh that, and you want to make sure that if you go through all of the hassle of doing this study, and you come to me and you tell me you can write off $90,000, and I tell you you can, but not all this year because you're limited for other reasons. It's complicated, so I don't think the scope isn't for what we want to touch on today. But there's some limitations to it, and we just want to make sure we can plan around those limitations.
Awesome. I don't know about y'all on the call, but when it comes to taxes, like my head starts spinning, and I know that I'm not equipped to do it or to deal with it. And so when you guys have a growth on your body, you don't try and self-diagnose it, right? You go to a professional. And when we have friends in our world that are trying to buy a house, they don't try and do it themselves because they're in over their heads, right? And so when tax season comes, I just take my information to Keith, and he does an amazing job. It sounds like a commercial for him. It is. He's great. And I'm taking my team, all of them are going to go to Keith. So I just want to encourage y'all to consider going to a professional who can help you with all these different things, because there's, I don't want to say loopholes, but there's different strategies that you can employ to be more fiscally responsible. So I'm going to open it up now to y'all. You all had great questions so far. What other questions have popped up? Open forum.
Is he located in Columbus?
Good question. Yeah, I'm located in the Worthington area, so I'm right off of Route 23 and 270. So just literally right off the exit.
Now, are you with taxes, are you only licensed in the state of Ohio? Because I do coach in Kentucky, and Kevin is on from Kentucky.
Yeah, so I can do taxes in any state. We have clients who start here and then they move to California or Florida, and we continue to do their work. So I can't go to Kentucky or go to other states without having additional licensing and practice there, but I can do any state and anywhere. So yeah, we're fine. I'm happy to help with anybody who lives anywhere in the country.
Beautiful. What other questions, folks? If no one else has anything, then I want to just give you all back some time. Thank you so much to Keith. If we could all unmute and say thank you to Keith.
Thank you.
Thank
You're
you.
welcome. Yeah, let me know if there's ever anything I can do to help out.
Man, this was awesome. And also, guys, you will sound like a pro if you ever have a client who says anything about tax. You say, "Hey, I got a guy," and you refer them to your CPA, or if you don't have one, refer them to Keith. I've referred multiple people to Keith that are not in the real estate industry who just want help with their taxes, because it is quite a bear. So, thank you all, guys. Keith, enjoy your holidays before the calm before the storm, I'm sure.
Yeah, absolutely. Thanks, guys. We'll talk to you soon.
All right, bye.
All right, bye.
Hey guys, for those of you still on the call, we will not be meeting the next 2 weeks. My kids are off with school and stuff, and it's the holidays. Attendance will be sparse anyway, so we're going to give you back that time. But please don't stop working. Don't stop lead generating. What you do now will show up in January and February. So don't stop just because the rest of the world's stopping. Okay. We'll talk to y'all later. Thank you all. God bless. Have a happy holidays.